Good evening, class, and welcome to our performance management class for ICANN lectures. Today, we are discussing the topic divisional performance. Divisional performance. Earlier, when we talked about transfer pricing, we spoke about divisions. We spoke about divisions that as a result of divisions doing business with each other, we will have transfer pricing issues. Now, we are looking at divisional performance. We'll be looking at things like investment, profit, revenue, and cost centers. Then we'll look at something called divisional performance evaluation, then return on investments and residual income. Return on investment and residual income we looked at. Then the divisional performance and depreciation economic value added. These are some of the things we are going to get from today's lecture. So, ride with me as we are about to take a ride on this topic. Every manager is able to care for his own and they are responsible. So the operations of the manager, so the management, where they are responsible for is called the responsibility center. A manager might be in charge of a department such as a warehouse or the buying department. As part of their responsibility, they could ensure that different operation goes smoothly, efficiently, economically. They kept cost under control. They reduce cost by all means. They make profit if possible, and they are also subject to approval by their superiors. The manager might also be responsible for a department that earns revenue. So it's not just only cost. So when they are in charge of things that has to do with only cost, they try to keep cost under control. Sometimes when they are responsible for earning revenue, they try to maximize their revenue, boost their sales team, make sure that they get revenue that will make the department cover its costs. When a manager is responsible for both costs and revenue of an operation, is also responsible for the profit that is earned. So it means that you are responsible for um, if you are responsible for costs, meaning that you are keeping costs under check. That means it is a cost center. If you are responsible for revenue, so there's nothing like revenue center. It means it's a profit center, meaning that you are responsible for the revenue and the profits that accrue from that revenue, right? So it's a profit center. Now, what are some of the things you could do with your profits? Some managers have the responsibility to decide what they can do with the profits. Should they turn it on into the business, or should they do what could they do with the profit? Now, some cases too, a manager might be responsible for decisions on capital investment into the operation. So it means that not only are they interested in keeping the cost low, making revenue high, so that making profit, they are also interested in the capital that they put into the business that will generate more profits, that will reduce their costs. So that means they are investment centers, because buying a capital is an investment. So large companies, the managers could be having this autonomy to manage their investments. So you can see that. Okay, so let's talk more about this. An investment center is a division within an organization where the manager is responsible not only for costs and the revenue, but decisions relating to the assets of the divisions. Most times, this is what we'll be looking at in these our classes. An investment center manager usually has authority to purchase new assets. We'll be seeing that a lot. Some of the assets could be plant or equipment that will be used for business. And so, the person will be responsible for the profits that this asset invested in return to the business. The performance of an investment center can be measured by calculating a profit as a percentage. So when we calculate our profit as a percentage, it's called return on investment. Return on investment. So ROI, return on investment. Now, return on investment is profit as a percentage. Now, an investment center might include a number of different profit centers. For example, a car manufacturing company might have cars and trucks and may have two investment centers. One of them is the car making and the truck making. Within the truck making division, there might be several profit centers, each of these with a separate location of factory at which trucks are manufactured and assembled. So what are we saying here? Investment centers, you are responsible for the investments being made by the company. And why should you be interested in the investment? It means you want to buy these new assets just because you want to increase your profits. And your profits can be measured. One way is using return on investment. Now, let's go to divisional performance evaluation. Decentralization of authority. Decentralization involves the delegation of authority within an organization. So it means that authority is not coming from the center, which is from the head office. Now, in a large organization, authority is usually delegated to the managers of cost centers, revenue centers, profit centers, investment centers. So when we say decentralization, we are talking about divisionalized structure, whereby each unit has its own management team that reports to the head office. And this decentralization help them to take decisions without waiting for the head office to necessarily tell them what to do. For example, they will not necessarily wait for head office to tell them when to sell, what assets to buy, should they give discount. They are responsible for that. Now, what are the benefits of decentralization? Decision making improves because divisional managers make tactical and operational decisions, and top management is free to concentrate on strategy and strategic planning. So you don't have to wait for head office to start making division tactical decision, operational decision, telling you prices to sell, telling you should you make discount, should you no. Managers in those departments or those branches take those decisions, but the head office will now be left to plan and do strategic planning instead of concentrating on tactical planning. So that's one advantage. Decisions made at tactical and operational level should improve because the divisional managers have local knowledge. So now what it means here is that, let's say you are a company, large company, and you have different branches, and you decide to give out managerial roles to local indigenes there. You see a qualified person that can handle that, you made a manager there. He knows the terrain of the area. He knows what obtains in that area. He knows what it takes that will sell. He knows how to approach who is who there. And when they make tactical and operational division, it should be far better than someone who is from the head office, who is not even there, making such decision because they have better local knowledge being right there. So that's the second. Um, talk about the first one. This is the second one. So the third one should division decision making should improve because decisions will be made faster. So you don't have to wait for convening meeting. Okay, before we make decision, we have to channel all our decision to head office. Head office will now have to sit down, deliberate, and get back to you before you now take investment decision. Sometimes all these things could cost you some of your business. So, but when divisional managers take decision on the spot, sometimes they will say, take a decision while on your feet. It could be fast. Take advantage of what opportunities you have locally, and that goes to improve the division's performance. So you see, decision making can be fast. Another one here is managers may be motivated to perform well if they are empowered to make decisions and rewarded for performing well against fair targets. So it means that you take decision as a manager and your decision go well, head office could reward you and say, oh, your decision was good. It even helped the overall company to improve. Or when we look at your performance, wow, based on the decision you made, your return on investment used to be 15%. Now you have turned it over to 20%. Wow, you are making good performance. They can reward you. So it could be rewarding to management or managers if they are empowered to make decision. And when that decision proves to be true or good, they are rewarded, especially when they meet their targets. Another advantage here is division provide useful experience for managers. who will one day become top managers in the organization. So by virtue of the fact that they have become managers at their various divisions, they are playing a role, or they are practicing their role that they will play when they become top managers in the organization. So this experience will be brought to bear when they are having top managers role. Now, within a large multinational group, there can be tax advantage in creating divisional structures by locating some divisions in countries where tax advantages or subsidies can be obtained. So it means that if you locate your factory where maybe it's very closer to raw material and they have kind of um, tax advantage there, you could produce some of your products there and ship them to your, or transfer them using transfer pricing to your other divisions. So you see here, you don't need to be in a place where raw material will be very, very costly to buy, whereas you can make your 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 organization to be in a place where you can source for it well, reduce your costs, get favorable tax advantage, and that's how multinationals can thrive. So when you are a multinational, divisional performance is also very key, especially in different countries. What are some of the disadvantages of decentralization? When I say decentralization now, making divisional autonomy. Divisional managers might put the interest of their division above that of the organization as a whole. Take, for example, when we are doing transfer pricing, where the buying division we want to put its own interest ahead of the organization. They will leave buying from the selling division and go outside to go and buy and take um, advantage of small price reduction to increase its profits. The selling division might decide to also put the advantage of their own. Instead of selling to the buying division, they will be selling more to the external market and thereby making the internal buying division to go outside to go and source where they will buy. And sometimes it might not be for the good of the organization. So this word here, goal congress, I mentioned it when I was talking about divisional and transfer pricing. Now we are saying it here. Taking decisions that benefit a division might have adverse consequences for the organization as a whole. When it happens, there is a lack of goal congress. There's a lack of goal congress. So it means that if the organization as a whole should benefit, there should be goal congress. It means the goal of the division should synchronize with the goal of the organization. And it also means that when there is a conflict between the organizational goal and the manager's own personal goal, which one should suffer? It is the manager's personal goals should suffer. But managers, because they are having to, they will be they will be rewarded or punished based on performance. They will want to put their own interest. Their interest is profit making. So it doesn't matter whether it harms the organization as a whole, but as long as they are getting profit from what they are doing, personal profit, then they may want to take that decision. So that is lacking goal congress. So it could come as a result of divisionalization or decentralization. Second one is top management may lose control over the organization if they allow decentralization without accountability. So if they allow, take decision you like without making them accountable, it means that they will lose control. So it means that top managers should be able to monitor division performance closely. So if they monitor the divisions closely, they'll be able to control when the managers are trying to harm the organization as a whole by their actions, because their selfish interest, they they may want to take decision because they are given autonomy, and because they have selfish interest without proper supervision, they might harm the company in the long run. It is difficult to find a satisfactory measure of historical performance for an investment center that will motivate managers, divisional managers, to take the best decision. It is difficult to find a satisfactory measure. For example, measuring divisional performance by ROI, which is return on investment, might encourage managers to make inappropriate long-term decisions. Just because you want your return on investment to increase, you might make the wrong decision. So there's another kind of measure that we usually use to measure the performance of management. They call it residual income. So we have return on investment, we have residual income. These two will be discussed here. But sometimes these two decisions um, usually work against each other. Sometimes return on investment might tell you invest. Residual income will tell you don't invest. So if you say you want to increase your returns and you go and invest in when residual income says don't invest, you might harm the company. You might take inappropriate long-term decisions on investment. So that is what happens when we do not find a suitable measure that will all be in sync. Economies of scale might be lost. That's another thing here. Economies of scale. For example, a company might operate with one finance director. If it divides itself into three investment centers, there may be need for four finance directors, one at the head office, one at each of them, cost investment center. And so when they need to take advantage, they want to make a purchase. Let's say, for example, they want to buy flour. Each of these divisions decide to buy flour on their own. Let's say all of them are buying 300 bags, and there are four divisions, 300 bags. All of them will be getting 1,200 bags. Now imagine if you are not going to get a discount until you hit 500. And if one center is collating all the purchase, so it takes your need 300, 300, and the company decide as a whole to buy 1,400, 200 bags. You can imagine the low rates that they will get, the discounts they will get, and everything, because it is centralized. So they can buy it and then ship it to their three different divisions. It could even be that after they have bought it, they could tell the company, the shipping company, that instead of bringing them as one lump, they could share it and take it to their three different branches. And they save themselves that time and energy. So economies of scale will be lost if everybody is operating as a whole in its division. Now we come to something called controllable profits and traceable profits. Profit is a key measure of any financial performance of a division. Profit is very key. So when you are measuring profit, it is good to know those costs that can be controlled by the manager of a division and those costs that can be traced to a division. Any cost that could be controlled by the division, costs that can be traced to a division. These are controllable costs, plus other costs directly attributable to the divisions over which the manager does not have control. So there are some costs that managers could have control over. Those costs are controllable costs. And there are some costs that is forced down on them. Those ones that are forced down on them, they have no control over. For example, there may be an allocation of general overhead, such as a share of head office costs. Those ones the manager have no control. When head office say this is your share of cost, so that's a general cost. These are costs that are generally allocated. But the one that is incurred, especially by the divisions, sorry, is called controlled costs. Profit and investment centers often trade with each other, buying and selling these services. These are internal sales, which are priced at internal selling price called a transfer price. Reporting system should identify external sales of the division and internal sales as two elements of the total revenue of the division. Now, when we are doing transfer prices, we usually separate external sales, we usually have internal sales like we did before. Now, let's look at controllable profits. We have the external sales. This is what this department sold to the outside world. It sold it at 600,000. Now, we have internal sales. It's been deducted. Internal sales. So it's been added. It's supposed to be added. So it's been added. When we add the internal sales plus the external sales, we have a total sales of 750. So these are your total sales, right? Now we have controllable costs by the divisional managers. The variable costs to do the product that you sold. All these ones are done by the manager because the manager is one responsible for buying those things. So this is 230, right? When you remove sales 230 from your total sales, this is the control, this is contribution. So this is contribution that you made. Now the fixed cost. Now the fixed cost here, this is controllable fixed costs. These are fixed costs that the managers can control by themselves. These are fixed costs that managers in each division can take a decision on. Of course, fixed costs are always fixed, like rent, other things are always fixed. These ones are controllable. Now, 140 is deducted, and you have controllable profit. So this is your profit that is controlled by the manager. So this 280 is controllable profit because we have dealt with sales. Sales is controlled by the divisions. Where to sell, price to sell, whom to sell. That's why we got internal and external sales. Variable cost controlled by the division manager. Fixed cost, the part that is controlled, gives us controllable profits, which is very important. Now, the costs that are traceable to the division, but outside the control of the manager. This one is called uncontrollable costs. You can trace that cost to the division. You can trace that cost to the division, but the manager has no control over it. When you minus it from your controllable profit, because it can be traced to the manager or the division, the profit you get is called traceable profit, because this is a traceable expense, fixed cost, traceable fixed cost. Now, when you get your traceable profit, then there is a share of general overheads. These ones are not traceable to the division. This one is from head office. It's not traceable to the division. They are forced down. And when you share these expenses to them, this is uncontrollable. This is uncontrollable cost, untraceable. This one is uncontrollable profit, but it's traceable. This one is the profit that is uncontrolled profits, because you cannot control that. And that is the net profit you have here. All right. So that's the general method or the format we shall be following when we are looking at controllable profit. We are asked to find controllable profit. Controllable profit, that's the one here. We are asked to find traceable profit. You know how to do it from this. But let's look at return on investment. Return on investment. What does it mean? Return on investment. We'll be looking at reasons for using ROI as a financial performance, measuring ROI. Then we'll look at ROI and investment decisions. Then we'll look at the advantages and disadvantages. Now, what are the reasons for using ROI? Return on investment is a measure of the return on capital employed for an investment center. So we have it here as return on investment. It's also called accounting rate of return. It's also called return on capital employed. So when you are doing ratio analysis and you see these rows, it is the same thing as the ROI. It's also called, it is an adaptation of profit margin. But this time around, it's not profit margin, it's um it's a kind of return on investment. So it means instead of the profit being the denominator, the the investment is the actual denominator. Those investments in the capital, the return on capital employed. We will come to see how we are going to use to measure it now, but let's see why we are using it. It is often used as a measure of divisional performance for investment centers because the managers of investment center is responsible for the profits of the center, and they are also responsible for the assets invested in the center. So if you are responsible for the assets you put into the business, you're also going to be responsible for the profit that comes by using that asset. Now, return on investment is a performance measure that relates profit to the size of the investment. So what they are telling you is that unlike profit margin, where you will be measuring profit as a percentage of sales, this time around, we are measuring profit as a percentage of the assets that you employed to make that sale. Now, profit is not a suitable measure of performance of an investment center. It does not make the manager accountable for his or her use of the net asset employed. So that's the note of warning here. Even though it is used as a performance indicator, it is not a suitable measure. You see, one of the problems we said to find a suitable measure, but we still use ROI as an indices to measure the performance of a division when they are investment centers. For example, look at this. A company has two divisions which are treated as investment centers for the purpose of performance reporting. Center 1 has net asset of 5 million and made a profit of 250. So you can see here, this is Center 1. They made a profit of what? 250, and their net assets happens to be what? 5 million. Now look at Center 2. Let me use here for Center 2. Center 2 has, they made a profit of 150,000 and had a net asset of 1 million. Which of these two did well? The one that made 250,000 naira profit over a 5 million naira investment, or the one that made a profit of 150 over a 1 million naira investment? Which of them did well? Now let's see. If you are to calculate the ROI, you are simply going to say the controllable profit, which is the 250 here, divided by the controllable investment, which is the 5 million. Now multiply it by 100 to get the percentage. So that gives us 5%. So the ROI here is 5%. Let's look at the ROI here. The controllable profit here is 150,000. And the controllable investment is 1 million. Now, when you multiply it by 100, it gives you 15%. So if you look at it here, the man who made 5 million, who made 250,000 profit, is not doing better based on ROI. The man who made 150,000 is doing far better when using ROI. And now, assuming that you are basing their performance on 10%, assuming your 10% is your cutoff, and you say anybody that made a profit, or if you have return on capital employed of 10% and below, that means you didn't do well. Maybe their cost of capital, good, their cost of capital is for the organization is 10%. If the cost of capital is 10% and your returns is 5%, it means that it's costing you more than what you are making as returns. So it means that you say Center 1 is not doing well, but it's making a profit of 250. And now you're saying Center 2 is doing far better, but it's making a lower profit of 150. So that is what return on investment does. Now, measuring of return on investment, look at the formula here. controllable profits divided by the division's capital employed, which is the size of the investment. So we can use controllable profits all over assets employed. This is one way by using controllable profits. You can also use traceable profits. Of course, if you use controllable profits, your ROI will be higher than when you use traceable profit, because your traceable profit is usually lower than your controllable profit. So you can use traceable profit all over the division's investment. So whichever profit is given to you, you shall know that you use profit. So profit is usually measured as an accounting profit after deduction of what? Depreciation. So you have to, if they told you that there's a depreciation charge that has not been deducted, you need to deduct that depreciation before you calculate your profit. Now, what is your capital employed? So we've seen profit normally is your profit before depreciation minus depreciation will give you the profit that is usually used. Capital employed should be the sum of the non-current assets used by the division plus the working capital that it uses. So it means your non-current assets plus working, or call it net working capital. This is what is your capital employed. Capital employed, your non-current assets plus your net working capital. And now, net working capital alone is your current assets minus your current liability. That is what your net working capital is. All right. Now, your non-current assets should be measured at their initial cost. Measured at their initial cost. However, it is more usual to measure non-assets at their carrying value, which in an examination question is likely to be the cost less accumulated depreciation. But normally, you need to measure it at the original cost in which it is bought. But if you measure it at cost less depreciation, you are also correct. So it's either you use your initial cost you bought them, or you use your net book value or their carrying value. Capital employed may be capital employed at the beginning of the financial year. So the capital employed may be the capital employed at the beginning of the financial year, the end of the financial year, or the average capital employed. So you can use three methods to look at your capital employed. They can tell you capital employed is usually at the capital employed at the beginning of the year. So look out for the exam question. It will tell you capital employed at the beginning of the year is what should be used. Sometimes they will tell you capital employed at the end of the year. Sometimes they will tell you average. So when they say average, you need to add the beginning and add the end, divide by 2. So most times they usually ask you to do either average or employed at the beginning. Where possible, the capital employed by the division should be analyzed into capital controllable by the manager. That is where possible in the question. Try to find the ones controlled by the manager and traceable to the division if possible. Now look at this. An investment center has reported the following results. These are the results that has been obtained. We have sales for the current year and the previous year. 600, 600 the same. Now, gross profit, we have 180 and 210. Net profit 24 and 30. Now, look at assets at the beginning of the year. Look at this asset at the beginning of the year. Now, they said we should discuss the financial performance of the investment center. Now, they said ROI is measured using net assets at the beginning of the year, because this is the asset that was given to you from the question beginning of the year. Now, how do you measure the ROI here? Without looking at this answer here, let's see here. This could be current, this could be previous, and so you can say um, net profit over net profit all over beginning. So this is just a rough estimate of how you can assess it. So you can say 24 divided by 200 multiplied by 100. So first one will give you 12 divided by 100. So the first one will give you 12%. So the current year is like 12%. Let's look at the second one. 30 divided by 180 times 100. That will give you, sorry, I think I've made a mistake here. 30, I can say times 100, same thing, divided by 180, still the same thing, 16.67. 16.7%. Now let's see what this answer is saying here. Return on investment should be used to measure the performance of a division, but other financial ratios should also be used if appropriate. In this example, sales revenue growth in the current year has been 0%. So you see here, the sales growth here from previous year to current year, 100, no, 0% growth. But if you can look at it again, we can measure the we can also measure the gross profit margin and the net profit margin. So what is the gross profit margin? Gross profit margin is gross profit here. So you can say gross profit all over sales. Gross profit all over sales. So in this case here, your gross profit is 30% and 35. Net profit margin would be this net profit here over sales. So here you have 4%, 5%. Return on investment, which we just did, could be 12% or 17% as we got before. So you see here, in the case of gross profit margin, it fell from 35% to 30% in the current year. Net profit margin fell from 5% to 4%. Now, return on investment fell from 17 to 12, which is a very large fall. So the total investment has increased. But look at the investment. Investment increased from 180 to 200. Meanwhile, the returns fell. So you are having an increase in reduction in returns, an increase in bigger investment. So a reason for the fall in return on investment is the fall in gross profit. So you see there was a fall in gross profit. Why would there be a fall in gross profit when the sales are the same? Perhaps the cost was much in the current year. You are selling 600 revenue, your costs should also have been the same, but maybe your cost was a little higher. Anything could cause that. It could be inflation, it could be anything that could cost it. It could also be inefficiency as a result of the production, wasteful of material. Maybe you also the pay you made to your factory workers were increased and all that. Wage rate, you increase your wage rate. Maybe as there's a new minimum wage, it increased and it increased your labor and your gross profit now fell. Anything could happen, fell to 30%. Other costs have been reduced from 180 in the previous year to 156. Cost 180 to 156. The other costs, when you say, how do we know other costs? Other costs is what gave rise to net profit. So if your gross profit is 210, let's try it here. If your gross profit is 210 and your profit is 30, that means your other costs is 180. Now, if your gross profit is 180 and your profit is 24, it means other cost is 156. That is what they are talking about here. Other costs have reduced from 180 in the previous year to 56 in the current year. But in spite of the reduction in other costs, in spite, forget the part that you made high your operational or your factory costs or your direct costs or was increased, your operational cost reduced, but in spite of that, the net profit margin fell. In spite of the increase reduction in cost, your net profit fell from 5% to 4%. Now, can you see the way these things is being analyzed here? If you're analyzing things this way, you have different measure, gross profit, net profit, return on investment, and you give an explanation, then you are going to be a good analyst. Now, the net profit fell by 1%. The failure to achieve any growth in sales in spite of the increase in investment, because there's an increase in investment, and the fall in the gross profit margin are the reasons for the deterioration in financial performance by the ROI. So why is this previous year from what we just did before, the previous year is better than the current year? Is because the gross profit fell and your assets increased, but your sales did not. So these are the two main reasons that caused this deterioration. This could be caused by intense competition in the market. You know, when we said intense competition in the market, the people could be selling at a particular price, and you may be using a target cost. You can be using a target costing method whereby you have fixed your price. You cannot go above that price, and you are trying to measure your profit. You want a particular profit margin. But now you remember when we did cost gap, your cost gap could not be closed, and it even affected your your sales margin. So it could be intense competition. People want to take over your customers from you, and you decide to sell even at a lower profit from what you are supposed to be selling. And so there's no growth in revenue and there's a fall in the sales price. Now we've seen return on investment and we've seen how we measure it. The performance of the manager of an investment center may be judged on the basis of ROI, whether the division has succeeded or not in achieving a target ROI for the financial year. So it means the company will, as a whole, will have a target ROI. I gave an example, say 10%, and That 10% is possible that's the cost of capital, and they want you to, if you can meet that up, that means by way of investment, they are either they are making neither profit nor loss. Because if your cost of capital is 10% and your returns is 10%, it means you're not making any profit, like break even. And that may be a cutoff. So anybody who's making less than that will be seen to be performing abysmally low. And those that are making higher than that may be commended. If an incentive scheme is in operation, a divisional manager may receive a bonus based by achieving the required ROI. And so investment center managers may have a strong incentive to improve their ROI in their division and to do anything that will reduce the ROI. Now, even if working or making decision that will harm the company, but just to boost their ROI. This can be a serious problem when investment decisions are involved. When investment managers' performance is evaluated by ROI, the manager will be motivated to make investment decision that will improve his division's ROI and reject any investment that will reduce their current year's ROI, even though the company as a whole is saying, take this investment. And they're saying, no. The problem is that investment decisions are long term. Now, can you see it? Investment decisions are long term. When you buy an asset, you use assets over a period of time. The depreciation you are going to be removing is for a period of time. The profits you are going to make from that asset is for a period of time. Now, the investment decision is for long term, whereas the ROI is just a short term measure. So the problem here is the new investment in the first year, when you invest something into if you make a decision to invest in the first year that you make that decision, it is very much likely to reduce your return on investment in the first year. But in the subsequent year, it might increase. But because manager is looking at what they will get in that year, they might say, oh, this investment is going to disturb us. We are not going to take that investment decision just because they want to boost their own return on investment for that year. An investment center may therefore reject an investment because of short-term effects of the ROI without giving proper consideration to the longer term that the investment is going to make. So can you see that? ROI is not really a better measure because managers can use that short-term decision, short-term indices to make wrong decision on something that should have been a long-term enjoyment of the asset. Now look at this example. A division has net assets of 800 and makes annual profits of 120. So this is the net asset. So you can see here, this is the asset that was invested. This is the profit that comes around. It should be assumed that if the investment described below is not undertaken, so that means there is an opportunity to take an investment decision. there is an opportunity to take an investment decision. If they said no to it, they are going to continue to have net asset of 800 and annual profit of 120 for the next 4 years. So what is going to happen here is this. If so when investment is not taken, investment decision, okay, investment decision not taken, just a moment. When the investment decision is not taken, your ROI here will simply be 120 over 800. What is it going to be? Okay, say times 100%. What is it going to be? Let's see something here. We're analyzing it. 120 divided by 800 multiplied by 100. So yeah, it's continue to going to be 15%. So you are going to have 15% as your ROI for the first year, 15%, second year, 15%, third year, 15%, fourth year, 15%. So managers have considered that. Now, the division is considering an investment in a new item of equipment that would cost 80,000. Now, the estimated lifespan of it is 4 years with no residual value. So, what it means here is this new asset alone, 80,000, you use it for 4 years. So, 4 cancel itself here, 1, 4 cancel here is 2. So, your depreciation every year is 20,000. This is your depreciation every year, 20,000 every year. So because it is having a lifespan of 4 years and no residual value. Now look at the estimated profits that will come before depreciation. So what happened now is this. If you want to know the controllable profit, you need to remove depreciation. So remove 20,000 here, remove 20,000 here, remove 20,000 here, remove 20,000 here. So what does it happen? This is going to be 0, this is going to be 5,000, this is going to be 15,000, this is going to be 20,000. This is profit after depreciation. Now, required. What will be the ROI on this investment? ROI should be measured on the basis of the average net assets employed during the year. Average net assets. Should the investment center manager decide to undertake the investment? Now, this is it now. Like we estimated before, this is the profit for each year without investment. The one that when we don't take the investment, look at the profits we are making each year. Now, when we take the investment, I've analyzed it here, which I brought down here now. Now, this is the extra profit that you can make from the investment. So, just the investment alone gives you extra profit. So, if you are adding that investment to your, like, look at what it says here. They said the estimated additional profit. So, this is not just the total profit, this is the additional profit. So, it means that you are still going to make your 120, and in addition, you are going to be making this extra profit. So what is it going to be? Your total profit is going to be 120 in the first place. So you're going to do this plus this, give you this. Now, what is going to be your net assets? How do we calculate that? So let's see. You have 800,000 in the first year. right? And 800,000 in the first year, the beginning of the year, 800,000. Now, you now added 80,000 to it. How did they say your investment? They said ROI should be measured on the basis of average net employed during the year. Okay, so you made 800, you have 800,000, then you now bought an investment that is 80,000. That means at the beginning of the year, you have 880,000, isn't it? That's good. Now, at the end of the year, depreciation of 20,000 has gone off from this 80, so it becomes 60. So at the end of the year, you have 860,000. And when you divide this by 2, what do you have? So we say 880,000 plus 860,000 divided by 2. And that's the 870 that we have here. So that's this 870 we have here. So what is your return on investment? It's simply this divided. Let me make sure that it is divided. So it's going to be this divided by this. So you have your 120 here, 120,000 divided by 870 times 100. And that gives you the first one, 13.8. That is done. You now go to the second year. When you have the normal one without profit and you have extra profit of 5,000, you have 125. Now what happened? The assets at the ending of the year, at the beginning of the second year, your asset was 860. So this ending, the ending asset for the last year becomes beginning asset for the second year. Then there's a 20,000 depreciation. So that means your asset is going to be 840. So when you divide it by 2, the net asset will give you 850,000. So that's what is here, 850,000 that's here. So you have 125,000. So 125, sorry, 125,000 divided by 850,000 multiplied by 100. Now that gives you 14.7. So for the second year, you have 14.7. Mind you, without the investment in the first year, see your ROI without the first year, you're getting 15. Second year, you're getting 15. Third year, you're getting 15. Fourth year, you're getting 15. That's what you get each year when you don't invest. All right. Now, in the third year, your assets, you had 840 at the beginning. Then, because of depreciation, 20,000, you now have 820. When you divide by 2, your net assets will now become 830,000. So that's the 830,000 we have here. That's the 830. So 135 divided by 830 will give you 16. And when you do the last one, 140 divided by 810 give you 17.3. Now you are comparing which one is better. They said, note here that assets are 800,000 plus the net for the new investment. just the way we said, the net assets have a new value investment of 80 at the beginning of year one, 60 at year two, and so on because of the depreciation. So we've talked about it. Without the new investment, the ROI will be 15%. But I look at managers. Managers will be looking at it. This first year, if I meet 15%, maybe that's the target, and now I'm getting less than 15%, I will not be rewarded the way they will reward me with 15%. Even in the second year, even in the second year, I'm getting less than 15%. And now in the third year and the fourth year. But if you look at it now, let's check something out here. 13.8 plus 14.7, sorry, plus 14.7 plus 16.3 plus 17.3 all gives me 48.87. All give me 48.7 if you're looking at it as a whole. I'm not sure. Okay, I didn't do this well. Start again. 13.8 plus 14.7 plus 16.3 plus 17.3. That gives me 62.1 as against 15, 15, 15, 15, which will give you 60. At the long run, you are 2.1% higher in the 4 years than when you don't take the investment. So in the long run, the company as a whole will benefit if you take in this investment. Take in. But the manager will say no, because for the first 2 years, he's going to lose his returns. So you see here, the new investment will reduce the ROI in the first and second years and increase in the third and fourth year. It is therefore probable that the divisional manager, if he's more concerned about financial management, financial performance in the short term, will decide that this investment should not be undertaken, even though over the 4 year period, the investment may be worthwhile. So, investment decisions should not be taken on the basis of ROI, even though divisional managers are tempted to do so. So, yes, they'll be tempted to do so to check their ROI and be looking at short term. The short term will be blinding them. Assuming that this performance that occur in the second, the third, and fourth year were done in the first and second year, they would have taken it. They may just be blind also to the shorter ones that will come in subsequent future. They may want to use other measures to ensure that those do not occur. But you see, investment decision or performance of managers should not be solely based. Investment decision should not be solely based on ROI. Now, if you look at it now, we can calculate the average ROI from this proposed investment. Look at the total profits before division. What are the total 4 year profits before division? How do we know? You add all of this. Okay, no. Add all of this. 120, 120, 120, 120. So this is 120. 120. So this is the first year profit. Depreciation over 4 years is 80,000. Total is of the 4 years is 40,000. So this is the profit you have before the investment, before the depreciation. Okay. Now look at annual profit from the investment. Annual profit from the investment. What is the annual profit from the investment? This is 20 plus 20. This is 40. So 80 plus 0. Okay, they still got 40,000. Okay. At the end, they have 25% as the ROI. Well, I can't seem to fathom how they did this, but we'll come back to it. That this is higher than the ROI of the 5% achieved from the division. So what they did, I don't know how they did it, but we can always do our own the long way. Add all the profits, all of these, add all of these together is the total investment. Then we look at the, let's look at it another way. Let's look at it another way. I can say this is 120 plus 125 plus 135 plus 140, and that gives me 520. Let's try something. Total profit, total profit 520. And we can now say, so this is the profit after depreciation. This is the profit after depreciation. Now let's look at the assets at the beginning, net assets. We have 880 at the beginning, and this is the third year. We started with 820 and end with 800, which give us 810. Okay, so 880 at the beginning, and at the end we have 800, because when all the depreciation has taken a toll on the asset, it will fall back to that 800. And when we divide it by 2, 880, so it will give us about 840 or so. So let's see, 880 plus 800 divided by 2, that will give us like 840. So we can say 520,000 all over 840,000 times 100. Let's see what we are going to get. 520 divided by 840 multiplied, let's do something again. 520, that's the profit over the 4 years, divided by 840 multiplied by 100. So I'm getting something like 38%, 38 point something percent. So I'm getting like 38 point something percent, which is like more than the 15%. So, but even though we do it this other way where we added all of these, so we can even do it this other way too, where we have 13.8 plus, sorry, I didn't do it well again, 13.8, uh-oh, 13.8 plus 14.7 plus 16.7. 17.3 plus 17.3, that's 62.1. If you divide 62.1 by 4, it's as good as getting 15.525 as against 15%. So in either way we are doing it, it is still better to undertake the investment. Now, what are the advantages and disadvantages of ROI for performance? Now, one of the advantage here is it relates to the profit of the division to the capital employed. So you are looking at what is the profit that would justify making this investment. So what are you returning as a profit for the capital we gave you? So it makes the manager responsible for the profits. I cannot be giving you something worth 1 million naira to make an asset purchase, and you are bringing a very small profit. And the profit you are making is now, and what you used to make before, there is no much difference. So you should be using profit to justify your turning around of the business when I invested money. So you cannot be investing money to someone without making them responsible for profits. So it helps managers to be responsible for profit. ROI is a percentage measure and can be used to measure the performance of different sizes. So it means that it is easy to compare because it's a percentage figure. So if you want to know if you are performing better than another company, and you just tell the person, ah, my company, my return on investment is yes, my return on investment is 20%. And I want to say, oh, mine is 22%. You know, the one that is 22% has more returns. So it is easy to compare. You can use it to compare different divisions, different companies of different sizes, different industries. So it can be used as a good comparison. Now, it can be easily measured. It's understood easily as a measure of financial performance. So if somebody say, my return on investment is 20%, all you know is for the assets that you employed, the person who gave you the money for the asset, you are giving him 20% returns. So if someone tells you that, come and invest in my company and I will give you 20%. So all you need to know is how much are you putting as capital? How much are they paying you back as profit? So it's easy. Then next one here is it focuses attention on capital as well as profits and encourages managers to sell off any asset that is not useful and avoid excessive working capital. So they avoid excessive working capital because that will reduce their ROI. So it means that their receivables should be smaller. That is, their credit sales could be smaller, or they should make sure that their receivable days is shorter so that they will collect their receivable days, collect their working capital. Then maybe their payable days may be longer. That way they have reduced their net working capital. What are some of the disadvantages? As explained earlier, investment decisions might be affected because divisional managers will be looking at short term that will come from the ROI and to make them to make inappropriate investment decision. Another disadvantage is that there are different ways of measuring capital employed. We might use the net book value at the beginning, we can use the net book value at the end, we can use the average. We could even use cost in these three instances. And using it that way, you will not get the same return on investment. So the return on investment you will get when you're using just the beginning value will be different when you're using the ending value, will be different when you're getting using the average. It will also be different if you're using cost or carrying value. So the comparison of differences between organizations is therefore difficult because you are using different methods. So somebody just tell you, I made a return on investment of 25%. Another one is saying, mine is 22%. You'll be wondering, which, how did you measure your assets employed? Person, oh, I use net assets at the end. I use net asset at the beginning. Is there a fair measure? Another will say I use the average for the year. Another will say, okay, even I use average for the year, but I didn't use carrying value, I use cost. So all of this makes it difficult to measure to compare because when you are comparing two organizations, they should be doing it similarly. It's only those that did it similar with yours. Maybe they use both of you use average carrying value. Then you can say, okay, my my percentage is better than yours. Then the third one, when assets are depreciated, return on investment increases each year, provided that the annual profit is constant. Now, can you see what we did here? First time, when the when the depreciation, the first year it was 13.7, second year it was 14 points. So each time there is a depreciation of assets, ROI is increasing. The profit was constant, yes, but normally profit will not be constant, revenue will not be constant. But you see, each time there is a depreciation, there is an improvement of the ROI. Divisional managers will not want to get rid of aging assets. They will not want to get rid of it. They will keep using it because each time they are calculating depreciation, an asset that is obsolete, they will still want to be using it because when they when they remove it, their net asset will be smaller. They want to be keeping it and it improves their ROI because ROI will fall if new assets are replaced. So that will be the point of our next discussion, replacement of an asset. We are gradually going to investment decisions. So when assets are being replaced, it affects the ROI. So they keep getting using the old one, even though the thing is giving them issues. So you can see how what the disadvantage of using ROI because it will make managers don't want to invest in new assets. Now, ROI is an accounting measure of performance, an alternative system of performance measure that includes non-financial performance, such as a balanced scorecard, might be appropriate. So this is just only accounting measure, only measuring performance. It's not talking about the non-financial aspect. For example, look at the example we use when an asset is aging. It will not be functioning well. It might take a longer time to finish product. It might be we might be replacing parts. every time. We might be servicing too frequently. It might also be reducing our efficiency a little. These are non-financial factors. But ROI, we're just using profit over assets invested. No talk about non-financial measure. So now we have seen residual income, return on investment. Now look at another one here, residual income. Residual income. What is residual income? Residual income is another way of measuring the performance of an investment center. So residual income is different, an alternative to ROI. So it means if you don't use ROI, you can fall back on return on investment. And the question is, which of these two is a better measure? Residual income is measured in the following ways. We have controllable profit less notional interest on average controllable investment. Then you have controllable residual income. Or you can say traceable profit less notional interest on average traceable investment, residual income. We'll be seeing how we'll get that. Now, what is the imputed note interest, which is called notional interest, and the cost of capital? Residual income is calculated by deducting an amount called notional interest from the accounting profits. How do we get this interest? It is calculated by applying a cost of capital to the division's net investment. The most appropriate measure of net investment is the average investment during the period. Although in exam, you might be told to calculate it on the beginning of the year. So, imputed interest is the division's capital assets employed by the organization's cost of borrowing or the weighted cost of capital of the organization or the special risk weighted cost of capital. You had me mentioned cost of capital. This is where you will now use it. Now let's look at an example, what we did before when we did in residual return on investment. We are using the same example in return on residual income. Now we are told that everything is the same, but the division has a cost of capital of 10%. So what do we do? Look at the current year, look at the previous year. This is your sales. Sales is 600, 600. Your cost of capital is 10% at the beginning of the year, because you say here we use net asset applied to the beginning of the year. So you look at 10% of this, 10% of this. So 10% of 200 is going to give me what? 20. 10% here is going to give me 18. So when you remove it, so there should be 580. So there should be 582. So that's what is going to give us here. This is just a rough estimate. Now here, if you look at it here, your profit here, oh sorry, I went to use sales. Pardon my, I use sales. It's supposed to be profit. So your profit here is 24 and here is 30. So 24 minus 20 gives you 4. 30 minus 18 gives you 12. So that's what we have here. The same thing we have here. 24 minus 20. So that's it. So what it means here is the previous year had 12,000 and now the current year has 4,000. So it has fallen from 12,000 to 4,000. This indicates deterioration in the divisional's performance, although the residual income is still positive because they're having positive money, but the profit, it is positive in the sense that the return on investment is bigger than the cost of capital. As in the case when we did it the first time, when we did it here, in this example, it was 12% here and it was 16.7 here. They are all bigger than 10%. So you see here, it fell also. In the case here, they are still making profits because the 12% and 17% are bigger than 10%. Okay, so an analysis of the gross profit margin and the net profits and sales growth will indicate the cause of the fall in residual income. So when we analyze the gross profit, the net profit, and the residual sales growth, you see, like we did before when we analyzed it first time, you see why there is a fall in this residual. Now, did you notice here that return on investment, the result is in percentage? Residual income, it's in absolute naira value. Absolute naira value. Now, residual income and investment decisions. Now, one reason for using residual income instead of ROI is that residual income has money value. ROI has percentage value. So if you tell someone, my return on investment is 20%, another one they say, mine is 15% too, you may be thinking the one with 20% performed more. But when you hear the monetary value, you may be forced to think again. A company may prefer to measure performance in money terms. In other words, residual income is similar to ROI as a measure of divisional performance. Though ROI is in percentage, residual income is in monetary terms. Now, looking at the example we did before, where the division made a profit of 120, decides to get a new investment over the next 4 years, which will cost them how much? 80,000, and it will be depreciated over 4 years. But now we see here that the cost of capital is 12%. Cost of capital is 12%. Okay. Now, how will we do this? How do we do this? Look at the profit we had without investment for the first year. So this is year one, year two, year three, and year four. So if you decide not to take the investment, you are going to be making only 120. Now you decide to take the investment. Before depreciation, you had 20,000, 25,000, 35, and 40. Now you have depreciation. Every year you are removing depreciation. And so what will be your profit at the long run? This is going to be your profit 120, 125, 135, 140 as we got before. As we got before. Now, notional interest. Notional interest. How do we calculate notional interest? Now look at what I'm going to do here. We had 800 at the beginning, then we now have 80. Now let's see something here. They said notional interest should be calculated on the basis of what? Net, average net. So don't forget this. Average net assets employed during the year. Average net. So we have at the beginning 880. Then we now have at the end 860, right? So that means average was 870, isn't it? If you apply 12% on 870, what will that give you? 870,000 times 12%. That is what gives rise to this 104,400. Right? Now, the second one was 850 in the second year. If you multiply 850 by 12%, 850 times 12%, that gives you this 102 that we have here. So the same thing when we do with 830 and 810. That is what we'll be having as our notional interest. So when you remove this notional interest from your divisional profit, you're having your residual income of 15,500, 15,600, 23, 35, 42. So you see, residual income, of course, it was increasing according to the when you are going, you are increasing. Now this is the what you get for the whole 4 years. Now let's add them up. Let's see for the whole years. 15,600 plus 23,000. Let's check something. 23,000 plus 35,400 plus 42,800. What it gives me is 116,800, right? It's like 116,800. Now, if I divide it by 4, let me see the average I will get in a year. Let me divide it by 4. I have 29,200. So this is like 29,200 averagely in a year. Now, assuming you didn't take the investment, you're only going to make 120,000 naira profit. The asset is just 80,000, 800,000. Notional interest 12% will give you 96. Residual income will be 24. Each year you'll be making 24. Each year you'll be making 24. Average in a year is 24. So compare 24 and 29,200. Which one is better? So if you look at it, okay, this is what they calculate for the notional interest. So if you look at it now, if the investment is undertaken in the first year, you'll be looking at 15,600 versus 24. You look at it is smaller. Second year is 23 versus 24. It's still smaller. But look at the third year, it's bigger. Fourth year is bigger. If you want to look at the broader picture, if you find the average for the 4 years is bigger than the average for this one without the investment. So if divisional managers is mostly concerned about short-term performance, they will decide that the investment should not be undertaken in spite of the long-term addition to the residual income. So, like return on investment, residual income can also make managers short-sighted. All right, what are the advantages and disadvantages of residual income? Now, one of the advantages here is that it relates the profits of the division to the capital employed by charging notional interest, which is also called cost of capital. Now, residual income is flexible measure because different cost of capital can be applied with different risk characteristics. So it's flexible. So you can say, okay, what if the cost of capital is 15%? How do we fare? If it is 10%, different risk. So it is flexible. What are the disadvantage? Residual income is an accounting base and will suffer the same problem with ROI because they are accounting based. Now, the main weakness is that it is difficult to compare the performance of different divisions using residual income. It is difficult to calculate the performance of different divisions. Larger divisions are supposed to earn bigger residual income than smaller divisions. A smaller division making a residual income of 50,000 naira might be performing better in terms of ROI when it is by than a company making 100,000. So somebody may be making 50,000. That is the amount of residual income. And somebody may be selling, maybe the person is maybe selling recharge card or you doing POS and is making return on investment 50,000 each month or so. While somebody who is selling car, or it may not be car, it may be something bigger, is making residual income 100,000. But if you look at the assets employed, it could be that the ROI is far better for the smaller company than the bigger company. We'll look at it in a short while. Now, residual income is not easily understood by management if they have little accounting knowledge. Now, let's look at this question to compare the two divisions using ROI and residual income. Two companies, big and small. Big division has an asset of 8 million, makes a profit of 900. Small division, net asset 400, annual profit 90. Cost of capital for both is 10%. If you are going to use ROI, so look at what you are going to do here. Let's say this is ROI. So this is big and this is small. So how do we get ROI? ROI is profit. So we start with profit. The big profit is making 900,000. Small one is making 90 divided by the assets. The big company has 8 million. Then the small company has 400,000. So what is the ROI for the two of them? Let's see. This is 900 divided by 8 million multiplied by 100. This is giving you 11.25. So this is 11.25%. Now, look at this small company. 90 divided by 400 times 100. This is 22.25. So the small company, in terms on ROI, the small company is doing far better than the big company. Although both of them, they are having return on investment higher than 10%, which is the cost of capital. The cost of capital here is 10%. Although both of them are giving returns higher than 10%, small company is doing far better. Now, if you are doing it in terms on residual income, so we have profit. So profit here is 900,000, and this is 90,000 minus notional interest, which is 10%. So here is 10% of 8 million versus 0.4 million. 0.4 million means 400,000. So 10% of 8 million, 10% of 8 million is 800,000. 10% of 400,000 is 40,000. So, this one here, ROI. So this is ROI, residual income. This should be 100,000, and this should be 50,000. So here, in terms on ROI, the big company is doing far better than the small company. Big company has residual income remaining 100,000, but that's the big company. The small company is having just 50,000 remaining. So you can see there is a conflict between return on investment and residual income. So if you want to give a you want to appraise the performance, you will say based on ROI, the small company is doing far better than the big company and should be rewarded far better than the big company. Then if you are coming to now say based on ROI, the big company is doing better than the small company. So there is a conflict here. So this is what we are told here. So divisional performance and depreciation, ROI or ROI, the problem with depreciation. Now, if straight line depreciation is used and capital employed is based on carrying values, which you call the net book value, the annual return on investment and residual income will increase over time. We've mentioned that if profits are constant, that means like we use 120 every year. Then if assets are being employed and there's depreciation, we find out that ROI will increase over time. And secondly, if assets are not replaced, so it means that no matter how old they are getting, don't replace them. In the early years of an investment, the ROI or ROI may be very low. We saw that in year one. In year two, it started coming up small. If a divisional manager is concerned about the effect this will have on their performance key measurements, the manager may refuse to invest on the project. This is because performance in the next year or so might even be worse through the project, might even be worse, even though the project might be expected to earn a high return over its economic life. The tendency for ROI and ROI to increase over time if assets are not replaced means that divisional managers may prefer to keep old and aging assets in operation as long as possible, and they may prefer it over replacing with a new asset. So you can imagine using an old computer to work, and they are now trying to give you a new one, and you say, no, 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 no. This one improve your work. No, I want my old one. Can you see what's happening? So look at the question here. So let's look at this question. A company just opened a new division that will operate as an investment center. The following estimates of future performance have been made. The division requires an investment of 5 million. This is consists entirely of non-current assets. Non-current assets will be depreciated excuse me, at the rate of 25% of cost each year, and there will be no residual value after 4 years. Sales revenue in the first year will be 8 million, but in subsequent years will change as follows. There will be no change in selling price in year 2, but prices will reduce by 5% in year 3 and by further 5% in year 4. Sales volume will increase by 10% in year 2 and a further 10% in year 3. But sales volume in year 4 and year 5, but sales volume will be the same in year 4 as it is in year 3. Cost estimates are as follows. Gross profit will be 40% in year 1, but will change as prices are reduced in year 3 and year 4. There will be no change in the cost of sales. There will be no change in the cost of sales per unit sold. Sales per unit for cost of goods sold will remain stable. Annual overheads, including depreciation, will be 3,500,000 in the first year and the second year, and 4 million in year 3 and year 4. Then we are told calculate for each years 1 to 4 the sales revenue, the gross profit, the net profit. So that's what we are told to calculate. The answers are down here. You see, so that to save our time. Okay. Let's try and work out as and see what we can glean from here. So we can say there are how many years here? 4 years. So we can come here. This is year 1, year 2. This is year 3, and this is year 4. So we are told that the sales revenue in the first year will be 10 million. So what are we asked to find in the first question? We are asked to find sales revenue for the 4 years. So this is practice exercise 2. Practice exercise 2. So we are told to find sales revenue for the first year. We are told it's going to be 10.8 million. So this is going to be 10 million 800,000. Okay. Then we are told there will be no change in selling price in year 2. Okay. So looking at year 2, there will be no change in selling price in year 2. That means the same price that was sold in year 1 will be the same price sold in year 2. But they said sales volume will increase by 10% in year 2. So it means that if the selling price is the same, so this is sales revenue in 1. So we are counting sales revenue for year 2. If the selling price is the same and we are increasing the quantity by 10%, that means it will still increase the sales here by 10%. So that will be 10,800,000 times 1.10. This one is 100%. This 10 is the 10% increase. So it means that here, this is 10,800,000. Sorry. Yes, 10,800,000 multiplied by 1.1. That will give me 11,880,000. So this is 11,880,000. Okay, so that's for year 2. Then we are told there will be no change in selling price for year 2, but prices will reduce by 5% in year 3. So it means for year 3, sales revenue for 3, they say prices will reduce by 5%. So that means the sales revenue is likely to fall. So you say, how do you reduce 5%? It's going to be 0.95. But that's not all. Let's look at volume. Sales volume will increase by 10% in year 2 and a further 10% in year 3. What does that mean? It means that you will now say multiplied by, this is what we had in year 1, in year 2, 1.10. So they said, and a further 10% in year 3. So that means it is going to increase year 2's volume by 10%. So you will now still say times 1.10. So this 1.10 was for the year 2's volume. Then the further 1.10 is a further increase in year 3's volume. So without calculating 0.5 first, look at what it says here. So let's see what is going to be first. We have 10,800,000. If we increase it by 1.1, this is what year 2 sales is going to be when the volume increased by 10%. When you now increase it by further 10%, this is what it should have been in year 3. But of course, the sales price reduced by 5%. So you now put 0.95 and you give you 12,414,600. So 12,414,600. This is 12,414,600. Now let's look at sales revenue for 4. Sales revenue 4. We are told that but prices will reduce by 3% in year 3 and a further in year 4. Okay, so what it means here is you have your 10,800 and it was reduced by 0.95. That's for the year 3. And they say a further 5%. So you still do this again for year 4. And look at volume. They said, but sales volume in year 4 will be the same as in year 3. So in year 3, we had these two. We're still going to bring them like that. So there is no increase in volume. So the indices we use in year 3 is still remaining the same. The only difference now between year 3 and year 4 is that year 4's sales volume, sales price is going to be reduced by a further 5%. So if I just take the answer I have in year 3 and multiply it by 0.95, that will give me what I will get in year 4. 11, so that's 11,793,873. 11,793,870. So that means you now have to arrange them again. You now say these are your workings. So you say sales revenue for the year 1 is going to be 10,800. Year 2 is going to be 11,880. Year 3 is going to be 12,414,600. And this is going to give me 11,793,870. We shift it here. So this is going to give me 11,793,870. So that's your sales revenue. So let's confirm. Let me get a second copy of this here. Get a second copy of this here so that I can go straight to the solution and check if ours is the same with what I can did in the study pack. So if you can see, this is the same thing that we have that they have, although they are approximating their own to the nearest million. We did ours full working, so that's fine. We've done the sales revenue for each of the 4 years. Now we are told to look for the gross profit. How do we look for the gross profit? Gross profit. How do we look for the gross profit? We are told that, which information do we have for gross profit? Gross profit will be 40% in the first year, but will change as prices reduce in year 3 and year 4. So gross profit will be 40% in the first year. So what it means here is GP year 1, 40%. So you will need to calculate 40% of, so this is 10,800 multiplied by 40%. That will give you 4,320. So this is 4,320. So that's the first year. That is said, gross profit in year 1 would 40%, but will change as prices are reduced in year 2 and year 3. So gross profit for year 2, we still need to calculate 40%, 40% of this, because just the quantity, the prices are the same, but the quantity increased. So your gross profit for the second year is 11,880. Let's look for 40%. So that's 4,752. 4,752,000. Then if we calculate 40% of each of them, let's see what will happen. 12,414,600. Find 40% of it. 4.9. Let's see if it is the same. Okay, it's not 4.9. Now, I wanted to check something here. If I were to multiply this by 0.95, okay, no, that is not how they got theirs. Let me see what they did in their workings too. Okay, they had to find cost of sales. So that means cost of sales is 60%. Okay. 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 Year 2. Okay. Year 3. The same volume. Okay, they use cost of sales method. 60% is the cost of sales for year 1. For year 2, they take that of year 1, which is the same 60%, and they increase it by the quantity, 1.1. So this is the volume of cost of sales. That's fine. Cost of sales, okay, that's what they now put to minus to get your gross profit. Then we look at year 3. Year 3 is the same price, okay, the same quantity. So they use that of year 2 and now increase the quantity, and now give year 3 cost of sales to be this. Year 4, they have the same quantity, so it's the same cost of sales. All right. So since there is no sales volume change, so they got all this cost of sales, and they got your gross profit to be this. Then they now said we should get the net profit. How do we get our net profit? All we need to do is, after getting your overheads, then your gross profit figures. Now, what are we told about overhead? What are we told? They said annual depreciation, okay, annual overhead, including depreciation, will be 3.5 in year one and year two, and 4 million in year three and year four. 3.5 in year one and year two, year three and year four. These are the annual overhead we are told. So when we remove it from the gross profit, look at the net profit we have. Here was a net loss. Then at the beginning of the year, what was the assets employed? The division requires an investment of 5 million, which is consisting entirely of new non-current assets. New non-current assets, 5 million, and it will be depreciated at the rate of 25% each year. I think they are going to use straight line depreciation. 5 million. So it means assets at the beginning of the year is 5 million. If you remove 25% of it, let's see, 5 million times 0.75, that means you have removed 25%. That gives you 3.75 times 0.75, another 25% removed. No, sorry. This is not reducing method. 5 million, let's do it this way, times 0.25. That means each time you are removing 125, 1,250,000 each time. So if you remove 1,250,000 from 5 million, that gives me 375. If you remove again 1,250,000, you have 2.5. Remove 1,250,000, you have 1,250,000. So that's what they are saying here. Now your return on investment is going to give you your net profit here divided by your assets. So let's look at the first one here. Net profit is here 0.820, now divided by 5. That gives you that 16.4 that we have here. If you do similar things here, you will get that. The same thing when there is a negative value, you get a negative return on investment. So that's it. Now, you have used your return on investment. You are asked to calculate return on investment. Assume that the capital employed is the net book value of the investment at the beginning of the year. So it's the beginning investment that we use, net asset at the beginning. That's why we brought asset at the beginning. Okay. Now, if you look at gross profit, we have 40 here, 40 here, 36.85, 33.35. Let me see what I was doing before. Gross profit, 40, 40. Okay. Let me see why they use 33.35. So let's say 40 times 0.95. That's it. 30. Okay, no. Multiplied by 1.1. That's a different thing. So what they are using here now, gross profit margin. You take your gross profit here and divide by your sales revenue, you have 40. The same thing here is 40. When you try to do the same thing here, you get 36.8, 33.8. Then your net profit margin, when you are doing it, you're getting these values. Of course, you cannot have negative profit margin. So it's just zero. So you see here that analysis here, there is a tendency for ROI to increase as non-current assets gets older. This is most apparent in year 2 when ROI increases from 16.4 to 33.4, largely because of the reduction in the value of the investment in the division. So I want you to look at this analysis as it affects this question, and let's get the hang of it. So with this now, we have come to the end of today's class. Then the next time, we are going to be looking at EVA. And after looking at EVA, we will look at some past question on divisional performance. We may even, before looking at EVA, we might just go straight to questions on divisional performance and solve, then come back to EVA if anyone refers to EVA, and we look at how it can be used. So thank you so much for this class. I didn't want it to be too long so that it won't bore you when you are revising. So we've been looking at divisional performances. We've been looking at two measures when investment centers is the key. Investment centers are being used. Autonomous managers make decisions on what assets to buy and the profit that comes out of it. They now measure their performance using two measures: return on investment and residual value. Both of them are accounting measure. And sometimes both of them conflict with each other. We've seen the formula for ROI and the formula for ROI. This is important because when you're looking at divisional performance, sometimes it's a question mixed with transfer pricing will come with divisional performance. Like in one of the questions we were supposed to solve in one of our classes, and we had to defy it until we have this knowledge before we solve that question. I think in our next class, we're going to tackle that question, look at divisional performance and transfer pricing. Then we'll see how we proceed from there. So thank you once again for the time spent in the class, and I urge you to make good use of the video that will be sent to you. I'll see you again in my next class. Keep bringing your questions and I will answer them as possible as I can. Thank you so much and do have a wonderful day.